Hey there, it's Mitch Goldberg. How are you? It's nice to see you today. Welcome to Be the Boss of Your Money, my live stream about personal finance, investing, and all things financial, so that you could be the boss of your money. Today's big topic is a continuation of what we've been talking about, the rotation stocks, the pandemic stocks. There's a rotation going on from the stocks that enabled us to stay at home, work from home. You know the names. It's DoorDash, it's Netflix, Zoom, Teladoc, Peloton. These stocks have been absolutely smashed. We need to take a look at a few things. These are the stocks that are on the top of everybody's mind. I picked those 5 names because I think they are emblematic. I think they exemplify the work from home, stay at home stock sector. They've had huge runs last year. They've made people fortunes. And now people are giving it all back, losing a ton of money, losing a fortune. So let's talk about these stocks and what are the things that you need to take a look at to make a decision. If you're expecting me to come out and say, this is a buy, this isn't a buy, that's a buy, that's not a buy, that's not what this is about. It's about helping you to become the boss of your money. I'm going to give you ways and things that I would look at in order to make my decision. And we're going to get into it. These are the hottest stocks in the market, and these are the ones that people want to know about, although now they are the coldest stocks in the market. So let's roll the quick intro. Here we go. As the price of oil goes up, and there's so much... No. Really sorry about that, guys. Here we go. All right, welcome to my live stream. It's Mitch Goldberg. You're watching Be the Boss of Your Money. I do this live stream every Monday through Thursday at 4:30 p.m. Eastern Standard Time. It's about a way for me to communicate with you, to share with you, teach you, share with you, the lessons that I've learned along the way of over 30 years of being a financial advisor. I've seen all kinds of people from all walks of life make all kinds of mistakes, overcome all kinds of challenges, and have all kinds of victories. And I want to take those lessons, put them all together, and just barf it all out in this show, in this live stream, so that you could learn a lot. One of the things we talk about a lot here is the stock market. And we talk about the stunning changes that have taken place in the world from COVID, from the pandemic. I'm not going to get into all those. I just want to get into stocks right now. And there are a number of stocks that I think personify the pandemic trend, just massive growth opportunities last year that have turned ice cold this year. If you're just joining us right now, welcome to Be the Boss of Your Money. If you have any questions, please ask them in the comments. Words of wisdom, words of encouragement are always appreciated. And if you're watching this in the live stream, of course, welcome to you. Same for you. Any questions, ask me in the comments. I will definitely see the questions, and I can't wait to get back to you. I love hearing from you. So DoorDash, Netflix, Zoom, Teladoc, Peloton. I can go into other names, but ultimately, this is a group of stocks, work from home / stay at home, that have enabled all of us to stay at home during the pandemic. If you have a cable connection, if you have an internet connection, you were able to do a lot of your work, if not all of your work, at home. Some people may never go back to their offices. Some people may go back to their offices periodically, but things have changed. But now that we're in the reopening, something like half the country has received at least one jab of a vaccine. And the CDC just said no more masks if you're vaccinated with other vaccinated people in restaurants, indoors, outdoors. It doesn't apply yet to public transportation, but pretty much all other aspects of life, it does apply, except for localities and businesses that say you still have to wear a mask. We still have to abide by that. But overall, we're getting back to normal. And that means people are going out to eat. People are going to the movie theater. People are traveling. And people are going to doctor's offices again. It changes the equation, the growth equation, in terms of what these companies, these stay-at-home, work-from-home stocks had experienced. So stick with me. We're going to go through these companies one at a time. The first one I want to take a look at is DoorDash. Okay, so we're going to talk about DoorDash real quick. So I'm going to do a, before I get into DoorDash, I want to do a share screen. And I want to talk to you real quick about the Wood stocks. Do you know what the Wood stocks are? I'm not talking about Woodstock, the concert. Kathy Wood, fund manager Kathy Wood is the fund manager of the ARK ETFs. The stocks that she picks for her fund are named, are called the Wood stocks for her. And basically, she's technology, innovation, but technology and innovation, listen, you live by the sword, you die by the sword. These stocks are either hot or they're cold. These are not steady Eddie stocks like major pharmaceutical companies like Johnson & Johnson or a consumer staples company like Procter & Gamble. Okay, these are very volatile. So I want to share with you something really fast here. We're going to share screen, and I want to just show you some of her comments. Okay, I'm going to share audio. Okay, so let's see how this works. Okay. All right, so let's just play this and hopefully you can hear this, okay?
Sentiment you're pushing. Take a listen to what Kathy said Friday.
Listen to this.
I love this setup. The last time I was on, I think I said that this rotation was good news because it meant the bull market was broadening out. It was strengthening.
Oh, Kathy,
and the worst thing that could have happened to us is to have the market narrowly focus on just our ilk of stock, the innovation space. Instead, it has broadened out so that year to date, I think it's energy's up 40%, financials are up 27%.
Which you don't have because you're a tech fund, basically.
Time horizon, nothing has changed except the price.
Okay, let's kick that out. Okay, all right, we'll just get rid of that now. So, this is about let's see, the date for this was May 10th. So a week ago when the tech stocks were getting crushed, Kathy Wood comes out, the manager. She is like the ARK funds today. I don't know if you remember the Munder net fund of like 1999, 2000. It hit a high of about $115 a share in 2000, this mutual fund, and it went down to $7 a share. Okay. And I feel like the ARK funds are the Munder net fund of 2000. I'm not saying that this fund is going down to $7 a share, but it's the same concept. The Munder net fund was investing in all things internet, all things that made the internet possible, all things that made the internet useful. Stocks got crushed. Today's group of internet / tech / work from home stocks are way better than what we had in 2000. These companies have clearly defined mission statements. We know what they are. They are great companies. They are loved companies. So these are the companies that we definitely want to stick with. Okay. My wife is out there. Let's just see. Judy says, this is my wife, Judy. Okay. I love you. I think our kids are driving the DoorDash stock way up. LOL. I think you're right. And I think a lot of us, I think you're right. And I think a lot of us would tend to agree with you. So let's take a look at what I have up here for the Dash. Okay. So I'm going to go onto the screen here. Put myself up here. Okay. Here I am. This is from the Wall Street Journal. I don't know if you could see it. I'll make it a little bit bigger. Okay. Right here. DoorDash said it expects total orders this year to be between 30, this is 2021, 30 to 33 billion, an increase of as much as 33% from 2020, a more modest pace than the triple-digit percent growth rate in recent quarters. Analysts expect DoorDash's revenue to flatten or even decline for the first 3 quarters of the year compared with 2020. And if we take a look at a quote on DoorDash, okay, stock went out today at $133 a share, down from 256. I mean, that is just, it's about as much of a pummeling as you'd ever see, right? And even with that, the company still has losses as far as the eye can see because they're investing in the business and they're going to take losses until they could finally one day turn a profit. But Uber Eats is not going away and other competitors. Okay. So, the problem that I see with DoorDash, and I want you to think of it, forget DoorDash. Okay. I want you to think of it this way. Could DoorDash actually recoup its glory days and get back to that incredible triple-digit growth now that people are going back out to restaurants? You have to decide for yourself, but with the stock going from 250 and change to 133, the stock was clearly overvalued and people were so built up on it in 2020. But, this company's growth is expected to stay that way, triple-digit growth, for as far as I can see. So that's that one. So the next one I want to take a look at is Netflix. Let's take a look at Netflix. And while I'm getting to Netflix, okay, let's take that out of the screen. Okay. This is, let me get rid of that. Netflix. Okay. This is annoying. Netflix's subscriber growth slows as vaccinations ramp up and rivals gain strength. Today, you saw the takeover play for AT&T. Not quite a takeover, but AT&T is merging its Warner Media business. They're trying to with Discovery Channel to make a new streaming behemoth. Disney Plus is now a streaming behemoth in like no time flat. The thing is, the stock of Disney tanked from like 200 down to the one. Where did Disney go out today? I think it went out at the 160s, but let's just take a look. Yeah, 169. Okay, so Disney went out at 169. The high in the stock was in the low 200s, 203. That's a big drop for Disney, 203 to 169. Or I'll just show you real quick what that looks like. Okay. You see this over here? Let me make the screen a little bit bigger so that you could see it on your little smartphone there. So Disney from 203 to 169, that is a shocking, man. I mean, that is just a crusher. So the problem is Disney's subscribership growth to Disney Plus slowed substantially. Netflix stock came in a lot because they missed on subscribership growth, and the stock is down over $100 a share from its high. And if you look at its numbers, it's not exactly a cheap stock. And the problem is when these cheap stocks, think of it this way, stocks are like a voting machine. When stocks are up and have rich valuations, that means investors are telling you they expect good times to last, to go well into the future. But once you take those expectations away, these stocks sink. So if people are going to movie theaters, I'm not saying Netflix and DoorDash are going back to the levels, the growth and revenue models, or levels, I should say, that they had in 2019. But they're definitely going to be below, or they're not going to be what people expected in terms of growth from 2020. I hope that sounds a little bit better. Okay. The next one we're going to take a look at, I'm going to have to get out of here in a minute, guys. So I'm just going to take a look real quick at Zoom. Zoom admits it doesn't have 300 million users. Zoom overstated their user base. They've had hundreds of millions of people on Zoom calls, but that doesn't mean these people are paying subscribers. And from Gadgets 360, Zoom subscriber growth slows as people return to classrooms and offices. Still posted a great quarter. So Zoom is still an incredible growth stock. But the problem is, are people expecting too much from it? Not even a great company like Zoom could live up to people's earnings expectations. And if we just take a quick look at this one, all right, the stock still has a P ratio of 144.88. It's still a very high price stock. So even though they are still growing a lot, if they don't have the growth to continue what they had before, then the stock is roughly overvalued. And then we're going to look at DocuSign and Peloton, and then we're going to get out of here. DocuSign, Okay, DocuSign is lower. I don't know if you can see this on your screen. Let me see if I can blow that up a little bit. Okay. DocuSign is lower in late trading Thursdays, despite the company reporting better than expected results for its fourth quarter. The company expects things to slow, but nonetheless shows expected growth moderation in the new fiscal year. You know what that means? That means it's another example of another stock that is just, it's just another stock that is just has become overvalued. And then we'll take a look at Peloton. Let's see if we have so that was DocuSign. We went over DocuSign. Now we're going to go to Peloton. And Peloton, should you buy Peloton? Let's take a look at this article here from Forbes. Should you buy the Peloton beaten down stock? Peloton's business is a lot going for it. It's a great company. It's a great product. And if you know anybody who has a Peloton product, they universally love the product. And you could like get into a fight with somebody if you knock Peloton. But the problem is the stock has had such a huge move and the growth rate is starting to slow down. So that's the problem with Peloton. So is Peloton a value at this price? They recently raised a lot of money via some convertible debt. But if you think it's a buy, you have to think in terms of this. Are people going back? Are people going back to the gym? Are people going to get back on their real bikes and ride outside? This stock has gone from 171 down to 92. And every time it looks like it wants to bounce back, it drops even more. It's still extraordinarily richly valued. Yeah, they had to have a recall with their treadmills. Unfortunately, a child was injured, had an injury that resulted in death from one of the treadmills. So their products have been recalled. And Peloton probably fought a little too hard against regulators before that happened and made them look even worse. So here's the bottom line. When I look at DoorDash, Netflix, Zoom, DocuSign, and Peloton, what I am looking at are which one of these companies has a model that could keep it going into the future, that is useful. And when I look at these stocks, like Zoom is competing with Microsoft Teams, and Teams has like over 100 million people using Teams now, video conferencing. I think these stocks continue to be a source of funds for the economy reopening stocks. And, if I had to pick one, the one that I like the most, well, I have to be careful in terms of making recommendations on my live stream, okay? But when I see these companies, businesses, I see them all moderating in growth except one. So there's not a recommendation, it's just my opinion. I see one of these companies that could continue its growth, and that's DocuSign, and I'll tell you why. It gets us further and further into the paperless office. Once you've used DocuSign, you will never go back. It is so convenient, so easy to use, makes record keeping, transfer of documents, storage of documents, passing along documents, signed documents. It's a wonderful company. They do an incredible job. And I don't see growth for them slowing. Businesses use DocuSign. And once businesses get a taste of what they could do with a DocuSign, why would they ever go back to faxing, scanning, and mailing documents? Because DocuSign signature is as good as a wet signature. A wet signature means when you actually take a pen and sign the document. So that's the one I think that has the continued growth going for it. And that's my story. I'm sticking to it. Thank you very much for watching. I've got to run. You've got to run. I'll be back tomorrow at 4:30. And thanks all. Andrew Hirschon is out there. Just a real quick comment. Mitch, thanks for doing what you do and educating an old friend from the early years. Andrew Hirschon. Thank you, buddy. Great to see you. I really got to go. And thank you.